Emerging markets are always seen as a bit of like the Wild West of investing. Yeah, so they're always sort of seen as something kind of exotic, and when it goes up, people are interested, and then as soon as there's a problem, people exit and say they'll never go back again. And I think that is a preconception which has been justified really by the nature of the investment universe, right? And this is what we really try to do. I think the index is a very poor proxy for emerging markets as an investment universe. And so the portfolio is firmly focused on providing exposure to the positive reinvestment opportunities that exist within emerging markets, whilst mitigating exposure to the negative risk factors of governance and balance sheets and foreign exchange risk, so FX risk and governmental kind of government risk. And so we seek to dampen the volatility significantly through doing that. And actually that would be the biggest myth that I would like to bust, is that it's just a volatile asset class and you can never actually make sustainable long-term returns in it. I think the way in which we address that asset class actually proves that you can invest with a reasonable margin of safety and a reasonable level of conviction. In most portfolios, they are now forming a form of a sort of structural allocation. I think that allocation will grow over time. Okay, and I think that happens for a variety of reasons. First of all, the exposure of global emerging markets in the standard global equity benchmark is around 10-11%. That grossly understates the contribution of these markets to global output, job creation, future economic growth. And so I think that over time, that just increases as these markets open up, as they get more developed. As you see more active managers like us growing our presence there, helping to somewhat legitimize and formalize these markets, that will encourage greater oversight and greater participation. And so I think that sort of 10 to 11% level naturally grows over time. There will be hiccups along the way, but to us the sort of structural story is reasonably robust. Just alignment, right? We don't run any of the companies that we invest in. Okay, we don't run them. We are shareholders, we entrust our capital to the management teams, and we need to ensure that they treat it with respect and they do the right thing. And we lose the most money when that stakeholder alignment is either not appropriate or doesn't exist. And so ensuring that you've got trust in the companies that you invest in and that they're incentivized to do the right thing with the capital is absolutely critical to mitigating losses and then providing the firepower to generate returns over the longer term. And the second thing I would say is that ensuring that you own businesses that have the ability to take market share in downturns is critical. The best companies in emerging markets, the ones that you genuinely create the most value in, I feel, are those that keep investing in the downturns, further their competitive advantages, because when the upturn comes, they take disproportionate amounts of market share, they'll have a better product offering, the consumer will know that they've been there through good times and bad, and they generally just create more consistent value cycle to cycle. And so they would be the two things that, as a long-term owner of companies, I would strongly advise people to pay attention to. But there are a number of them. I mean, Bank Central Asia is a key one, Indonesian bank that provides that opportunity. Great management team, been throughout the Asia crisis, seen Indonesia in all different economic environments, and have consistently managed their capital well. I've talked about Lojas Renner in Brazil. I think they do a similar thing. One of the best things that happened to Renner in recent times was that the Brazilian economy went into free fall and all of the global peers exited, and they kept investing in getting better. And now as they exit that recession, they're really starting to capitalize on that. So they would be two stocks that I would reference as being in that sort of environment, and they're both heavily represented within the portfolio.